Hey, how's it going? In today's video, I'm going to show you how a 22-year-old working part-time was able to buy a $185,000 house with only $5,000 out of pocket. And not only was he able to buy a house, he was able to make an extra $6,000 the instant he signed. I will go over his home buying journey from start to finish, how the loan was structured, and I'm going to also show you on how the actual contract was negotiated when buying the house. And for a final cherry on top, I'm even going to show you how this house is going to make him into a millionaire. So when I first start talking to a client, there's a process called the pre-qualification process. The main purpose of this process is to get a gauge on how the buyer is in terms of their personal finances and what are their goals. So questions are going to be asked like, what is your income? What are your debts? How much money do you have saved in the bank account? What is your credit score? And things like that. And then what I go ahead and decide is, you know what? I think it is a good time for me to check your credit so that we can see what loan options you qualify for. I met my clients, asked him these questions. I checked his credits. He actually ended up having a very strong credit score. Now with the pre-qualification, I was able to get some rough estimates in terms of what he could afford in terms of a home value. And this first estimate was around $230,000. With this pre-qualification, I see a lot of first-time homebuyers make this huge mistake of, okay, I got this pre-qualification number and I'm going to go ahead and start looking for a house. I'm going to tell you, this is one of the worst things you can do because this is just a pre-qualification. Nothing is set in stone. At this point, loan officers don't verify documents, they don't verify other aspects of the finances, so like the client really doesn't know if they're even able to get this loan from the bank. That's why this is called a pre-qualification. Now when you talk to a loan officer, your main goal is to get a pre-approval. Now with this pre-approval gives you solid information in terms of, okay, this is how much you can afford in terms of a house. I already talked to a lender and you basically have the green light to look for a house at this price range. Moving on with the pre-approval, I went ahead and asked my client, hey, do you want to go ahead and move forward? I can get you the pre-approval, and then once I get this pre-approval from the bank, we can go ahead and start having you look at homes. He told me yes. I went ahead and got all of his personal finance documentations. I did some loan structuring, and then I was able to determine what home values he can get. Now with my clients, I usually like to do a green light, red light system. So basically when you have a loan for a house, there's a certain payment that you have to make every month. Now depending on how large the loan amount is, that payment gets bigger and smaller. Now when you talk to a bank, they're going to give you a maximum in terms of what you could afford in terms of a house payment. However, I do not suggest going towards that maximum because that's when doing the loan gets a little bit sketchy, because that's the point where you start writing the fine line of approved and not approved. So when you go ahead and submit an offer on a house, you don't want to be writing that fine line. You basically want to have a very strong green light that you can buy this house. So what ends up happening is I told my client this: you have the green light for any house that you want around $180,000. Then if you want a house more expensive, you're going to be getting a yellow light. Now for a yellow light, I told him that value is going to be around $200,000. Now this doesn't mean he's not going to get it. It's just a lower probability because we are hitting that higher loan amount value and higher payments. And keep in mind, your loan amount and your payments is all dependent on what your personal finances are. For the absolute red light, where I told him, hey, this is the absolute maximum in terms of what you can afford, and there's a probability that you might not get the loan for the house. And at that point, when you submit the purchasing contract for the house, you're just going to be dealing with a lot of stress. This red light value was around $210,000. Now keep in mind, what is the difference from the pre-qualification amount? That is a $20,000 difference. The pre-qualification was for $230,000, whereas in the red light for the pre-approval was $210,000. So if I give my client the green light with the pre-qualification to go start looking for homes, and then now he has to go into contract, the worst thing we want is for him to go under contract and learn the hard way, hey, actually, you actually have a low probability chance of getting this house. So that is why I always suggest to go ahead and get the pre-approval for a house, get a very, very strong basis on what you can afford without reasonable doubt. And if you do want to push that higher loan amount, I will disclose that there's a probability in you not getting the loan. That's basically what I told my clients. So the great thing about getting the pre-approval too is this gives you a basis in terms of on how the loan is going to be structured. So in terms of the bones for my clients, this was how the loan was structured. This loan was an FHA loan with 3.5% down and a mortgage payment of around, let's say, $1,400 to $1,500. With the price range of $180,000 to $210,000, I give my client the green light to go ahead and start looking at homes. Now, here is when we go into the home searching process. And this is actually one of the most stressful parts when it comes to basically finding a home to live in, because you are without a doubt going to be filled with a lot of choices, especially in today's market, which is 2024 of August, where home prices have been consolidating appreciating and interest rates are relatively high in the past few years. So what ends up happening in today's market is that home buyers have a little bit more power and leverage when it comes to submitting offers, because since homes have been on the market for a longer period of time, sellers are getting a little bit desperate. Usually what ends up happening is the home buyer gets a certain dollar amount on what they could buy. They start looking for houses in certain zip codes. Now that is completely fine, but I'm actually going to give you a trick on how you can find the best deal for real estate. So when you're looking for a house, you want to make sure you keep in mind one thing. How long has a house been on the market for? On average, homes are usually on the market for around 2 months. So anything above that means that this house, the initial price that it was set at, isn't the true value of the house, simply because it was never put under contract, nor has it even sold. So inherently, the price of the home is actually lower. So basically what this means is when you see a house that has been on the market for a long period of time, you actually have negotiating power when it comes to submitting an offer for the home. Then on top of that, what you can also do is when you look on Zillow to see the home, you can actually look at price deductions on the house. And believe it or not, there's actually a lot of price deductions going on in today's market. So make sure you scroll down, you look at the price changes for the home to see if the price decreased in value since it's been on the market and how long the house has been on the market. Because when you see a house that has been on the market for a prolonged period of time and the price has decreased, this gives you something very powerful. You can now ask for seller concessions. Seller concession is basically where the seller credits money to the buyer to help them with buying the house. Now this money can go towards the closing costs, down payments. However, the buyer wants to use the additional seller concessions to structure the loan. After my client saw around 4 homes, we ended up finding him a house that was for sale at $175,000. For this particular home, this home was on the market for 6 months, and the initial price of the house was $190,000, meaning that the seller has decided to decrease the value of the home by a total of $15,000 after the 6 months that the house has been on the market. And not only was the house for sale at $175,000, the seller of the home was actually offering $5,000 in seller concessions. So here's what's important to keep in mind for this house that my client liked. The house was on the market for 6 months, and the seller was offering $5,000 in seller concession, and also the price decreased by a total of $15,000 since it was first listed, meaning our buyer has a lot of power in terms of being able to negotiate the contract. So what me and my realtor ended up deciding was to submit an offer for the house for $180,000 and also ask for $10,000 in seller concessions. The seller gets the total value of the house that they want, and the extra $10,000 goes towards helping my client in terms of being able to buy the house with as little as possible. Now for an FHA loan, you can ask for up to 6% in seller concessions. So for $175,000, we are hitting around that $10,000 mark. Hence is why we ask for $10,000 in seller concession. Now, when you do ask for a higher value in the sales price of the house, the only caveat here is that the home needs to appraise for $180,000. So there is a little bit of a risk on offering more for the sales price of the house, because if the home doesn't get appraised for $180,000, we now need to go ahead and restructure and renegotiate the sales contract of the house and also the loan of the house. So with keeping this in mind, my realtor went ahead, drafted up a purchase agreement, and we submitted an offer on the house for $180,000 sales price and also asking for $10,000 in seller concession. Fortunately, this offer was accepted, so my client ended up paying $1,800 for earnest money deposit. Now I will note, even though I have a pre-approval for my client, we did ask for an option period which costed around $50, which basically gives us some more security for my client, just to make sure that all the finances are going to be set in stone, and if they are not, we have a good pull out option for my client and we save his money. So once you have a property that you like and you go ahead and submit an offer and you're locked into a contract, here's the glory of getting their pre-approval. So when you get a pre-approval from the bank, that is basically the bones for the loan and everything's set up in place. Now once you go into contract, all you literally need to do is you need to update the property taxes, get a quote for the insurance, and that's it. You basically are 90% the way there. Now the last thing you need to do is wait for a conditional approval for the address of the house, and then once you get that conditional approval, you order an appraisal for the home. Now for this particular situation, when we ordered the appraisal, some minor repairs needed to be done on the house, so we had to wait an extra week so that the minor repairs can be done, and then we get the final inspection updates for the house. Fortunately, after everything was said and done, we did get a full-blown approval for the loan, and not only did we get that approval, the home actually appraised for $185,000, meaning that my client is basically going to be getting an extra $5,000 in equity when he buys the house. So at the end of the day, here was the final loan structure for the house. So So the total loan amount ended up being around $174,000. The interest rate was at around 5.5%, and the total payment for the house was $1,300, which includes principal, interest, taxes, and insurance. And then for the final cherry on top, my client only had to come with a total cash to close of $3,500, which is absolutely ridiculous. Imagine buying a house for $185,000 and only needing to come to cash to close for $3,500. Absolutely ridiculous. And then on top of that, the mortgage payment is $1,300. That's dirt cheap in today's markets. And that is pretty much how my client was able to buy his house at 22 years old, only bringing $5,000 out of pocket to close. And not only was he able to buy a house with only $5,000, he actually made an extra $6,000 in equity just by buying the house. I already went ahead, the start to finish of the home buying process. I even went ahead and gave you some insight on how the contract was negotiated and also how the loan was structured with the seller concessions. Now, I'm going to go ahead and give you a bonus, and I'm actually going to show you on how my client is going to be set up to be a millionaire. Here, I'm going to show you an Excel spreadsheet, and we are going to be comparing the differences between renting a house and buying a house. Now, I do have the values of the house and the loan amount here. So as you can see, the home value was $185,000. The total mortgage payment with taxes and insurance is around $1,300. One thing you need to keep in mind, when you own a house, when you put the money for a down payment, that money is going in terms of the equity of the house. So you now need to consider your house as a little bank. Now, when my clients bought the house and it priced for more than the original sales price, my client had an extra $5,000 in equity, meaning when my client bought his house, he ended up having $11,000 of equity with only needing to come with $5,000 out of pocket. One thing that I like to compare is what is going to be the differences between renting out a house and owning the house. If you were to find a house and rent it out for $1,300 a month, after 30 years, he's going to be spending around $470,000 out of pocket. Now, here's the difference when you decide to buy and own the house. So when you decide to buy and own the house, you are now building equity because you get to ride the property appreciation wave of the total value of the house. And then on top of that, you pay down the loan balance over a prolonged period of time. So what ends up happening is, if we were to go ahead and say that the home didn't increase in value at all after 30 years, when you pay down the loan, you are still going to have around $185,000 basically in terms of the home value. And that's assuming that the home value doesn't appreciate. Now, if we go ahead and say that the home did appreciate in value by the national average of 5.44% for the past 50 years, look at the total home value. It's $906,000. Okay, so what ends up happening is, and by the time you finish paying off the loan, you now have nearly $1 million in equity, which is absolutely ridiculous. Now, with just that concept alone, what do you think is better? Renting out a house for 30 years and spending $500,000, or you buy a house and you now have $900,000 in terms of equity of the house? However, what is the difference? What is being lost just by owning the house? Well, you do need to consider taxes and insurance and also interest. Now, I already went ahead and estimated that to be here, which is the total interest ITI paid. If we went here and looked at the total cost, which basically sums up all the interest, taxes, and insurance paid over the 30 years, here we see that the only real cost was $300,000 in terms of the money that we lost. Now, I will disclose I didn't count the property taxes increasing or homeowners insurance increasing. However, the point still remains the same. Now, here is another layer we now need to consider. What happens after the first year my client lives in the home and he wants to live in another house and buy another house? Well, first of all, he can now rent out that house and start seeing rental income on the property. At the bare minimum, let's say that after the first year, he rents out the house and he just covers the mortgage payment of $1,300. So if we were to add all the total rental income that we see over the next 30 years, he would make around $452,000, which would cover a huge portion of basically paying down the loan for the house. So this is just a very scratch of the level. Obviously, there are a lot of caveats with my calculations. However, this is just a rough estimate. The point of the matter is this: if you just buy a house, you figure out creative financing, all the things you need to do to just own the house. Just by owning the house, you're going to become a millionaire with the property appreciation alone and also paying off the loan over a prolonged period of time. you can go ahead and bolster that just by renting out the house, making extra money, because now you don't need to come out of pocket to pay the house. You're now getting someone else's money to cover the cost of the house, and you're basically having someone else deposit money into your house, which is basically paying the loan over a prolonged period of time, which basically allows you to go ahead and pursue additional homes for real estate. That is all that I have for today's video. This is a very long video, but I just wanted to give you a lot of insight in terms of the home buying process, what it looks like, and how inevitably just with one house you can become a millionaire. Now imagine what happens when you have a strong team of a realtor and also a loan officer, and then you can go ahead and start building your portfolio of real estate and basically become a millionaire. Because this is with just one house. Let's just say you get one house every 2 years. What's going to happen? Well, let me tell you one thing. Everything compounds on itself. And with real estate, this is about the long game. And as long as you have a big picture idea with real estate, you're going to go super far in terms of how much money you can make. That is all for today's video. I hope you were able to learn a little bit more about real estate and real estate investing, especially for first-time home buyers. And I'm really happy that my client was able to buy his house. He definitely deserves his house. He has a very nice family, and I'm looking very forward in helping him to buy more real estate and turning him into a millionaire. If you can please go ahead and do me a favor, like and subscribe, share this video with first-time home buyers that you may potentially know. And if you are interested in buying, selling, or refinancing your house, please feel free to reach out to me via phone or email. Other than that is all for today's video, and I hope you have a great rest of your day.